What's up, guys? It is I don't know, say Tuesday the 12th. Crap, it's going by so damn quick, I can't even keep up with it. But I got Scotty Bear back on with us because we need to talk a little bit about interest rate stuff. Scotty gets an enormous amount of calls and handles an enormous amount of calls about interest rates and loan programs. And what are the big questions you're getting today, Scotty?
Not a big question. It's why are rates so high?
which is an amazing question to me with all the data that's out there. And then, of course, we've talked about it repeatedly about the ARMs and the interest onlys, but yet we still have the questions coming up about ARMs and interest onlys. And the bottom line is, it's not an advisable thing to do to go into the ARMs and interest only. So we're not going to go into that at all. You can go back a couple of episodes and you can see what we talked about that and the reasons why you should not do that. So, but we're going to talk about really, I think, going to the depth of today is what's going on with interest rates, because we're getting a lot of news stories out there saying they've dropped significantly, biggest drop since 2008, things like that. I don't know who they're surveying, but the data that they're providing, one, I'll guarantee the data they're providing is days old because, I've actually spoke to some of these people, been interviewed by some of these people in the past, and what they gather and when they publish is such a wide differential that the information they're giving is not the same. So what I think would be helpful, and let's take a look at what just Bankrate says. Bankrate is looking at us right now, and they're showing the 30-year fix. This is for owner-occupied, guys, owner-occupied deals. This isn't for your investor deals. Are you seeing the Bankrate screen, Scotty?
I am.
So what we're looking at, current mortgage rates, the 30-year fixed for people buying houses to live in, just barely coming off of its highs of what's claiming here of 5.91 down to right now it's 5.672. So 5.672 is really put closer to 5.7%. Now there's news articles being published out there that Freddie Mac is claiming it's 5.3. It's interesting how they're quoting Freddie Mac. How often do you see people quoting Freddie over Fannie, Scotty?
I'm sorry?
I say, how often do you hear anybody quoting Freddie over Fannie?
I mean, I personally never see it, but are usually Fannie's the go-to.
That's what I've always seen. People are always referencing Fannie Mae and what they're saying. Now, all of a sudden, Freddie Mac is getting in the news. And really, it's because what's going to get butts in the seats. I look at any news story, whether it be something that has to do with what's going on in politics and our social situations or finance, it's a lot like a movie trailer, right? They're going to put the best information they can in the trailer to get your butts in the seats. The thing that sucks about that is you go to this movie, you spend your money by that enormous amount of capital on popcorn and drinks and all that crap just to find out that the movie sucked. You got suckered in by something that was all the good stuff was in the trailer. Everything sucked otherwise. So right now they're giving you the best they can. So what we're going to show is I'm going to show you what I gathered from Freddie Mac's site. This is actually a history of all the rates since 1971. And I will scroll really quick so you can see how this works. And I'm dragging it all the way back. This is over 2,000 months. I didn't see the exact months here, but it starts out, let me see here. And there was that April 2nd, 1971, and they were tracking at 7.33%. And I'm going to slowly scroll here, guys. I'm going to stop at some rather interesting times. If you'll scroll forward, you get into the in 1975 is 8.8. In 76, 8 and 9%. These are the rates for people buying houses to live in, mind you. Look at this, 1978, 10%. Pretty much 78, 79 is 11% and 12%. 1980, 16. 1981, 14, 15%. We know these things. Look at how it's cranking up. 1982, when it starts to get really heated up, 17, 18%. Then it starts to come back down in 83 into 14s, 13s. 85 is a 12%. So you can see where this is at right now. What I did was I went ahead and took this spreadsheet and played around with it. And I got some averages. We'll go back and you can see here all the way back to I think it's 2009 when they started injecting money into the mortgage-backed securities. 4 and 5% was pretty common. Then we got into the threes in 2012 and 13, and threes again in 15. Then you see after the pandemic, we got down into the twos, right? That's what drove that down because of all the money being shoved in during the pandemic. So I've got an average here from 1971 to 2009. So 2009 is when the Fed started injecting capital into the mortgage-backed securities, about over $1 trillion. I think 1.25 trillion from January 1 or early January 2009 till March of 2010. 1.25 trillion was being invested at that time, and they kept that investment going. Well, if you look at the average from 1971 to 2009 is 9.11% was the average rate for people buying houses to live in. Now, in the pandemic, they dumped even more money in. So from March 20th of 2020 up until now, we're seeing an average rate of 3.33%. So you can see that enormous amount of capital being invested into bringing our rates down. The January 20th to, March 20th, 2020 to March 30th, 2020 was $1 trillion. Almost the same amount that they did in a year from 2009 to 2020, 2009 to 2010. That right there, 1.25 trillion from January 2009 to March 2010, 1.25 trillion. And in 10 days in 2020, they jumped in 1 trillion. Pretty crazy what they were doing there. Continue to put in billions of dollars every day after that. Now we look, since the average since 2009, just the quantitative easing period was 4%. So 4.022. Then I took the average since just from the very beginning, they were tracking this in 1971, 7.6. So if you look at that all the way up until the Fed's involvement, the average interest rate was 9.1%. After the Fed's involvement, we have an average all the way back to 1971 is 7.7% or almost 7.8%. But when you look at the Fed's involvement period, that averages out somewhere in the range of about 3.6, 3.7% is what the Fed's been doing there. So actually, it's about 4% is what the interest rates have been since the Fed has been involved. So goes to show that artificially our rates are being kept low because of all that involvement, but we know they're backing out. So I want you guys to see this and see this information. I'm going to save this spreadsheet. Anybody wants it, email me. We'll shoot you the spreadsheet. We'll share it with you so you've got it. Any thoughts on any of that, Scotty?
To me, the bigger take is you take our primary focus is the investor. So if you take the investor and they say on average, when you take primary residence rates, you can add, some people say a half point, 3/4 point, 1 point, but let's just say we take the middle of 3/4 of a point. If you look at the last 50 years and based on all the information that we've kind of gathered here, 8.5% is what the 50-year average would be for an investor. So as people are shopping around and kicking the tires on deals, what we're seeing for rates, whether it's in the, I don't think we see a whole lot in the high fives, definitely see a fair amount in the low sixes. To get calls and say rates are so high, I don't think the deal makes sense. You really have to look at the numbers because the rates, again, I tell everybody, the 2-year window of COVID, you have to remove that out of the equation because that just was not a normal time. And if we back that 2-year window out, where we're at, it's 6.125 or 6.25, 6.5, anywhere in there is below what we've historically seen for investor rates. So it's still a great time to buy. There's more inventory out there. You have to shop around and see what works and what doesn't.
100%. No, I get where people are coming from, wanting to shop, wanting to find the best they possibly can. Also the temptation of jumping into an ARM or something like that because your cash flow looks really, really sexy up front. But guys, remember that's right now when you close, that's the lowest your cash flow should be, with raising rents and continue to increase. And we're not talking about the crazy rent raises looking at today. That's not sustainable. I'm talking 3 to 5%. Run those numbers 3 to 5% going forward for 2, 3, 4, 5 years and see where you're at. And that starts to start compounding bigger and bigger and bigger as you go on. Now, if you haven't locked in your costs, like I was saying, with 30-year fixed and protected those costs for that 30 years, you're putting yourself at risk. you're putting yourself in a position where things can start moving on you a lot bigger. We don't know the outcome of this. As you can see, the average interest rate prior to any Fed involvement was 9.1%. I've been saying, when people keep asking me, where do you think we're going? I don't know that we're going to double digits. It's a good, solid possibility. But I'm just saying, we're going to go back to where it was prior to that. Prior to that, we're looking at 8-9%. So that's what it's showing us when you're looking at these averages. We could just go back to 2009 averages. Actually, a little bit prior to that, probably 2007. If you look at 2007, I was showing that looking somewhere in the range of about 6 to 7, probably, yeah, 6%, 5 to 6% for owner occupied. So we're talking 7-ish% for investors. That's where we're at right now. I don't know that we're going to be much different than where we are. So let's just get into the charts and show where we're at today and what we've got happening. So when you look at the news story that came out, they talked about Freddie Mac come out saying that we had the largest drop in mortgage rates since 2008. Well, I mean, I can see where they're coming from. You look right here where my cursor is, right? That's where everything bottomed out. And then it worked its way to this point. That right there, that influx of capital was driving interest rates low. Now, the reason this dropped so dramatically is because we got that reading from the Fed on inflation. We had March of this year saying it was 8.5%. Then you get April saying 8.3%. May, they thought it continued to go lower. Instead, it came out at 8.6%. Everybody freaked out. We're anticipating 8.7 this week. I guess CPI is coming out, right? So because of that reading, it dropped hard because everybody thought it was going to go the other direction, which still doesn't make sense to me. I ranted about that a little while ago. But because of that, then they settled into it. The Fed raised the rates 0.75% on this day here, and it started to crawl its way back. Well, because of that, this swing here, there was a big drop from here to here in owner-occupied stuff. I think when it comes to the mortgage-backed securities that we're really focused on for investors, we saw some improvement, some stabilization, not massive movement to the positive. In fact, Freddie and Fannie, or excuse me, Freddie is saying it was 5.3%. We were just looking at bank rate of 5.7. So I don't know where they're getting this Freddie Mac stuff, because we're not getting that when we price the Freddie. They're not any better. So I have no idea where they're coming up with that, but 5.7 is more like it. And they were claiming it dropped from 5.7 to 5.3. Well, bank rate showing still at 5.7. They've always published the lowest I've ever seen. So I'm not 100% certain that what you're getting is really accurate. All I can see is what I can see. Now, we've come off of that high here, which would be that low for interest rates, and we're back into probably more of a little bit of a mid-range. So maybe that's why we're showing 5.7, but that's a big jump. If they were saying we are 5.7 here, is what all the articles are claiming, went to 5.3 here, but why are we back at about 5.7 here if things were what they were claiming? So question that, talk to people you trust, talk to those who you work with that know are going to give you the rate that's reality instead of just what you're reading in the news.
Last time inflation was like this was back in the early 80s. I think rates were 14, 16%. So where we're sitting today, again, rates of 6, 7%, we're still in an amazing place with all things to consider.
Yep. 1982 is when we were at that. In fact, I'll just share a screen with you guys real quick so you can see exactly what it was. That way you don't have to take my word for it. Look at this. 1982, 17.3, 17.4, 17.6, all the way through 1982, guys, in the early parts of it. And the more it dropped, it was only dropping into the high 16s. So just be glad that we're not in that 17% range. And that was for owner occupied. Investors, typically you're a point to a point and a half above that. So that's 18, 19%, guys. So just know that we could be a hell of a lot worse. We're in really good shape. The Fed's going to probably raise the rate about another 3/4 more than likely. That's supposed to help inflation. It could help interest rates. So don't get all freaked out about that. But just also know every time that sumbitch talks, man, it shakes stuff up and it ain't pretty. And just know it's going to take 2 or 3 days to settle out. So don't freak out. Talk to Scotty, reach out. This guy has a nice, calm, soothing voice to talk you through stuff, talk sense to things. We'll make sure you're taken care of. Any final words, Scotty?
No, CPI will be big. I think it comes out tomorrow morning. It'll kind of give the Fed an idea of if inflation's under control or if it comes out worse than expected. We all know that the Fed will probably raise rates by 3/4 of a point, just so people know that doesn't correlate. Once they raise rates by 3/4, it doesn't transfer right over into, that's what happens to interest rates. Everyone's, it's pretty much factored in, but it's their guidance moving forward, you know, how they anticipate doing raises beyond that is what will trigger the market in a positive or negative way.
100%. It should hopefully do a positive way, but we'll find out how that works out. But we appreciate you guys always watching, and we'll see how this all plays out. And we'll talk to you guys again on Friday. I'm going to be trying to get signal from a remote location. We'll see how this works out. Thanks, guys.